The first thing to note is there's been an enormous number of bankruptcies in recent months in the retail industry. Who are the entities that have filed? You got Bed Bath & Beyond, Christmas tree shops, Rockport with those squishy shoes for old men. Do you notice anything that these entities have in common?
Lon, welcome to Real Vision.
Hey, thanks so much, Ash. It's a pleasure to see you again, to be with your viewers and your listeners. Really glad to join you today.
Well, the day is finally upon us. We've wanted to do this conversation for some time now. I'm really excited about it because I'm interested in credit markets, obviously, and I don't know a ton about private credit markets, which is one of your areas of expertise and obviously a significant and rising part of global capital markets right now. Lon, let's get started. Tell a little bit about what you do. One of the reasons I'm so excited to have this conversation with you is that you are literally in the room when these deals get done and have an inside view that most simply do never seem to get.
I'll give you a little bit about my firm and then me personally, because the dynamic is closely related. So our firm is called Riemer and Braunstein. It's a 100-year-old legal boutique that specializes almost exclusively in finance. So we've got 100 lawyers in New York and Boston, Miami, Chicago, Newport Beach, California, and pretty much everyone is a finance lawyer. About half of us do real estate finance. I don't do that. Those are the guys who advise people in constructing hotels and office towers, not my specialty. And then the other half of the firm is engaged in commercial finance, and that's my specialty. That's representing banks and non-bank lenders, hedge funds, specialty lenders, factors, supply chain firms, anyone who's providing financing that is not real estate focused. That's what the other half of us do, and that's my specialty. I've been doing it for 30 years, and I represent people from the top to the bottom of the debt stack. And what do we mean by the debt stack? So I represent people who are doing billion-dollar lev-fin deals at the top of the debt market, deals that are widely syndicated, that might or might not be packaged or sold to the secondary market. And I also represent hedge funds and non-bank lenders structuring smaller $100 million, $150 million revolving credit lines, term loan facilities, et cetera, so that people can run their businesses, both working capital revolving lines and term loans. And as I say, I've been doing it for about 30 years. And it's industry agnostic what we do. So the borrowers in these credit facilities where we represent lenders, they might be in retailing, oil and gas, technology and life sciences, literally any industry. And so what Ash and I were thinking was, I have a real unique visibility on a broad scope of lending activity. And hopefully that gives me the opportunity to give some perspective to the listeners and viewers about what I think is going on in the lending world right now. And before we get too deep, I just want to say that my opinions are my own opinions. So they're not necessarily those of my firm, my fellow partners here at the firm, or any of our clients for that matter.
Yeah, you said something that was really interesting, Lon, this idea that you're industry agnostic, which makes sense because we're talking about a globally fungible pool of funds in the capital markets. Let's start out with the basics. Talk a little bit about the nature of the capital stack. Obviously, there are a lot of different moving parts here. There are a lot of different options in terms of the ways that businesses can finance their ongoing operations. Let's start there before we get into the bigger macro discussion about the size of this market, which I think is going to be very interesting to investors as well.
Okay, now that's a good thought, Ash, to sort of level set. I have my own unique perspective about how these markets operate, how they exist relative to other markets. It's really an understanding of business in a capitalist client environment. And so the way I see it And maybe this is a little bit of an oversimplification for your sophisticated audience. So I'll ask them and you to indulge me a little bit. But if you're a partnership or an LLP or whatever kind of entity you are, whether you're treading water or you're expanding very rapidly, you need liquidity. You need working capital to go about your business. You need to pay your employees. You need to rent your real property. You need to buy inventory. You need to engage in R&D and so forth, buy machinery and equipment. So how do you do that? Again, at the risk of oversimplifying, I really think there are only three ways that this goes down as a practical matter. So this is Lon Singer's short, abridged version of how I see the world of liquidity and business operations. So at the high end, you've got the businesses that cash flow. What does that mean? You've got a handful of businesses, a tiny percentage of enterprise, where they throw off so much cash so regularly, without any peaks or valleys, without any real challenges, so much EBITDA, that they have all the ability in the world to conduct their business, grow their business, do R&D, do acquisitions, do anything they want to do, just on the basis of the money that they're cash flowing. So who are these businesses? These are the Microsofts and the Apples of the world. These are a fraction of business enterprises, and they're notable, and they really don't need anything from anybody. They just need to go about their commercial growth model. All right. The second category of three is the entity that avails itself of equity. And this covers a broad range. This is the startup that finds some angel investors, the startup that sells a piece to private equity, the guy who goes on Shark Tank and gives Mr. Wonderful 25% of the company. If you're willing to give away some of your business, you can get in cash for selling equity. Now, that's a huge market. It's NASDAQ. It's the New York Stock Exchange. It's not my specialty. My specialty is the third category, and that's debt, public and private debt. Borrowing money from third parties. And I would submit to you that the overwhelming majority of entities in America and globally, but I practice here, maintains one or more credit facilities with banks or non-bank lenders. And the way they operate is some of them run their entire cash flow through a revolving credit facility. So it's the basis of all cash that they use, and they flow it through, they recirculate it, they redraw it, they repay it. It's a little bit like your personal credit card. That's how they run their business. There are other businesses that might have credit lines for specific purposes. Maybe they have a term loan facility that lets them buy machinery and equipment or real property or do joint ventures once in a while. So there are even a significant percentage of entities that just want to demonstrate that they are so stable financially that they can enter into one of these credit facilities with some kind of a lender, and they have dry powder. They have rainy day liquidity if ever they need it. And that's a significant business in its own right.
Yeah, and this is where things get interesting, because obviously there's the flip side of that, which is there are investors who have money that they want to send off to summer camp and get a return back on that. And this is where things get interesting. Let's talk about the size of that market, the lending market, the debt market that is not moderated through commercial lenders, through revolving lines of credit, but rather through facilities, be they loans, bonds, and private credit. I mean, there's just a whole menu of options here that we get to talk about today.
Yeah, indeed there are. And the takeaway is that we've seen, you don't need me here to tell you this, we've seen a tightening in credit. I know your producer, Mario, has a slide, the first one perhaps for our viewers, that has a pronouncement from the Fed in late July of this year. That's it right there, thank you, in which they observed that the credit markets are all tightening. Again, you don't need me for that, but there are nuances that we're going to explore together that are valuable for all of us. What does it mean when the credit markets tighten? Yes, it's harder for consumers to borrow money, but it's also harder for businesses to borrow money. And when this happens, covenants are tightened. So businesses need to operate within narrower constraints. The flexibility that lenders, both banks and non-bank lenders, are willing to afford their customers gets narrowed. What does that mean? So, every credit facility has negative covenants. It says, listen, don't incur more debt beyond this limit unless you come to me for guidance, the lender. Don't take on more liens unless we've talked about it and we think it works for your business. Don't enter into a joint venture or a new line of business unless we confer with you and we think it's accretive and it makes sense for your business. So all of these constraints become narrower and more carefully enforced in an environment where underwriting is tightened. So
Right.
Businesses are finding it harder to borrow. And if you look at the next slide, you're going to see that there is, at the moment, both a declining leveraged and non-leveraged syndicated loan volume. We're really looking at the last 5 bars on the 2 lines of the graph below. I think I stole this from Bloomberg. But it's a widely reported fact that there is less lending going on, both regulated and non-regulated lending.
Hey, sorry to interrupt again. It's Raoul here from Real Vision. I'd love for you to subscribe to the channel, get the notifications. We have so many incredible conversations with so many amazing people. It will really help you in your financial journey and your journey to understand just what the hell's going on in this world. Anyway, click subscribe, get the notifications, and enjoy.
Let me just jump in here really quick, because this is where things get incredibly interesting. So we talk about on Real Vision all the time the macro aspect of this. Obviously, we know we're in a rising rate environment, tightening credit conditions, et cetera, et cetera. But where the conversation gets really interesting, and your expertise and what I'm most excited to talk about is the interface of the macro with the micro. What's actually happening on the ground and how it impacts investors and credit markets more generally. So let's bring that chart back up, Mario, that we were just looking at. Lon, talking about the menu of potential debt options that companies use to finance their ongoing operations. You have 2 broad categories here, non-syndicated loans and syndicated loans. Let's just start out by defining those 2 categories and talk a little bit about how they function in the marketplace. Who gets them? What are the options? What are the alternatives? And how do they influence the flow of credit in markets?
Absolutely. So the syndicated loan, simply put, is one that is not fully and solely and exclusively underwritten by a lead lender. It is made available in part to other lenders. These could be club loans. These could be widely syndicated loans. So I paper $1 billion deals where one of the 3 or 4 biggest money center banks is the agent, both administrative and collateral agent, and then it syndicates the loan within the banking community. So what does that mean? It invites its fellow money market, major banks to buy in pieces of the facility, 50 million, 100 million. Why does it do this? It's just like an insurance company. It's hiving off risk, sharing risk with other lenders in the marketplace. Those lenders in turn will do likewise in their large credit facilities. And the same guy who sold 100 million last week will buy 100 million next week, so that they're sort of spreading the risk around in the marketplace. Those are the syndicated loans. It tends to be larger loans that are syndicated because the underwriting for the particular borrower in question was done on the basis of, hey, we're willing to hold 100 million of this $1 billion loan, but we're not willing to hold more of that. Our commitment's 100, and we're going to act as syndication agent, and we're going to get the other $900 million sold, and then we're going to close.
So Lon, looking at this first chart before we move on to the next one of the things that's visually striking is how rapidly we see the non-syndicated loan volume decline. I mean, this is a pretty striking chart when we look at that visually. What's going on there?
Well, what that means is the guy who does the small loan, he is more nervous about holding on to all the risk associated with any given loan than the guys who do the larger loans, again, where risk is hived off and shared. So if you're doing a $30 million loan and you're holding the whole thing, you're a smaller lender, you've got 100% of the risk associated with that credit facility, And so your willingness to lend, your comfort level with how many borrowers that there are out there in your sweet spot is dramatically diminished. And maybe you're sitting on the sidelines a little bit until you think the lending environment comports with the criteria that you think are appropriate for you right now. So that's what's happening. The guy who can't share risk, he's willing to take less risk.
Yeah, and the other fascinating point is when you look at the chart on the bottom, you see that the folks who can syndicate risk doing exactly that. Now, there's been some a bit of a decline from H1 2021, but you see this huge jump. If you're not looking at this, if you're just listening to the podcast, this huge bump up on the syndicated loan volume in basically the end of 2020, beginning of 2021, which seems to imply exactly what you were talking about, this desire to share risk if you are one of the large shops that's able to distribute this debt.
Right. And the interesting thing that I would point out is don't assume that all the syndicated lenders that are reflected in that chart are the big banks, because they're not. There are enormous hedge funds and other private investor groups that are making enormous loans and that are syndicating their loans among one another and even to the banks. Money center banks, regional banks, other banks. So those guys are really the guys in the sweet spot right now. And let me explain what I'm thinking in that regard.
Yeah.
So, post Silicon Valley Bank, and I have a chart for this. Maybe you can bring that one up next. You'll see that you had the catastrophe with SVB, with Signature, with Republic. People got nervous about the bank space generally. And what does that mean? A lot of people who had their money at smaller banks said, I know it's FDIC insured to $250,000, but I'm a corporation. I have tens of millions of dollars at the bank. Where should my money be? Maybe it should only be at a gigantic money center, too big to fail bank, because we know the government's always going to protect my money in that setting. And so what happened? We saw enormous post-Silicon Valley Bank deposits as reflected in the attached promptly after the catastrophe with SVB and Republican Signature. So you would think, okay, the money center banks, the B of A's, the Wells Fargos, the JP Morgan Chases, they took in additional billions. So they must be eager as can be to lend. They're throwing lots more lending money out the door, aren't they? Well, no, the answer is they're not. They're hunkering down with all that additional liquidity. They're shoring up their stability. They're preparing to ride out any difficulties. They don't want government intervention again. Their memories are pretty good with respect to 2008. And so they, in fact, are not the guys who are doing the serious aggressive lending right now. So who is? It's the non-bank lenders. And I'll tell you why. So we talked a little bit earlier in the conversation about the fact that credit criteria have grown tighter. And Ash pointed out, and we all know it, interest rates have gone up. So what does that mean? That means the private lender is lending with tighter criteria, right? It's a less fast and loose lending environment. And yet he's getting a higher IRR. He's getting a higher yield. So what these guys are doing is pooling money, partnering up, working together. And I find that I am busiest right now on behalf of non-bank lender clients. And so for your investor audience, Ash, I would say, do some investigating about who these non-bank lender clients are, the large ones. Some of them are publicly traded. People are going to explore this after we get off our call today. We represent a significant number of them. And as an industry, they're in a bit of a sweet spot right now, I would submit to you. And that's worthy of some thought.
So tell us more about those types of agents, the activity that they're engaged in, and a bit of an overview of what their sort of overall position is in the lending industry.
Yeah. So, historically, they've been challenged. They have to compete with the banks. The banks have a cost of funds of nil. right? People deposit trillions of dollars. The banks have paid virtually no interest on that money for many, many years now. And so the bank has no cost of funds and it lends it to businesses. And so it is the most aggressive and first resource to a company that wants to borrow money. But these alternative lenders right now have a greater ability to ensure executing and delivering on their commitments to lend. People trust that they will get to the finish line with these alternative lenders almost more comfortably in the current environment than they have that feeling with respect to many traditional financial institutions. So are they paying a little more interest? Yes, they are. But 150 bips isn't the game changer when interest rates are quite high anyway.
Right.
And so there's a migration to these alternative lenders. The expectation also is that as business environments change and evolve, they're going to have a greater ability to ask these alternative lenders to work with them, if you will. Then they'll be able to do so with a traditional bank in many cases.
Lon, explain for people who may not know who these alternative lenders are and what those facilities are and how they're structured.
Okay, so the alternative lenders, some of them are hedge funds, some of them are non-bank commercial finance companies, some of them are factors, some of them are supply chain businesses. They are providers of loans and other types of financial accommodation that are privately held or publicly held, but are not regulated financial institutions. And that's the real touchstone, okay? If you're a bank, you have the Fed grading your health. You have the OCC evaluate, the Office of the Comptroller of the Currency, regularly evaluating the quality and stability of your portfolio. So you've got regulators looking over your shoulder all the time. So what you can do is terribly circumspect. And the private finance enterprise is firmly positioned to be opportunistic. It answers to no one but itself and its own investors. So these guys are really poised to move on a dime, to move with the marketplace, to seize the opportunity, and to be creative and aggressive, albeit a little less aggressive now, because it's a safer lending environment for every lender. They can demand more of prospective borrowers.
Yeah, I think our listeners and viewers can understand why I was so eager to have you on the show, Lon. We talk about the broader macroeconomic conditions, and what you're giving us here is kind of the microeconomic connection to how these agents in the system function, why they do what they do in rising rate environments, specifically if we talk about what's happening right now. And I think it's so important for people to understand the internal dynamics of the system. One of the things that I think confuses a lot of people who aren't in the debt space is there's kind of a dizzying array of options here, from bonds and fixed income, leveraged loans, private credit. Talk about the big buckets of lending, how you think about them, how you classify them, and what role they play in the credit system.
Yeah, they're all closely interrelated. It's like a boat on the ocean. There's shifts between and among them all the time. It's only a special company that's in a position to issue bonds to the public. A smaller company that needs a $75 or $100 million working capital credit facility, it needs to go to a traditional lender or a non-traditional lender and borrow money. And that's really my sweet spot. People borrowing between $15 or $20 million and $2 billion. That's the world I live in, both with traditional lending institutions and the non-traditional private lending institutions. That's my sweet spot. And by focusing you and your listeners on that segment of the lending market, what's interesting is, we can take something other than a monolithic view of lending. It's very easy to sort of kick back and say, hey, lending is tight, money's expensive, that must be bad for businesses, probably not great for the economy. Okay, but there's no value in that. Let's focus. I think if we focus on a couple of industries, for example, and think about a couple of industries and how does the lending environment impact them, that might be particularly illustrative. Will you indulge me with that?
Yeah, let's take a look at that. And I just want to say, to point out the other point that you made there, which is such an important one. When people talk about the corporate bond market, for example, as you point out, it's a very small tranche of the most elite companies that have the ability to raise funds on that market. You know, Microsoft and Google can issue debt.
That's right. Public debt is for the Fortune 100, the Fortune 250. Day-to-day businesses, even very substantial businesses that are treading water, businesses that are expanding a little bit, businesses that are hitting critical mass, businesses that may be enormous at some point, all of them need traditional borrowing, signing up for a credit facility with somebody. And that's the overwhelming sweet spot that I live in, and where most of the money moves around.
So let's take a look at the industry by industry view. I know you've got some data prepared.
Yeah, no, absolutely. So let's think about the retail industry, for example. People are interested in that. We all go to the mall or we don't, and that has an impact on society. But the retail industry is one that I'm very close to, very familiar with. And the reason I'm interested in it is that it's one of the logical largest users of revolving working capital credit facilities. And you say to yourself, why? Why retail? Well, let's think about it. The retailer has an enormous rent roll, right? He's got to pay for stores all over the country. The retailer needs to expend a fortune every month on thousands of employees, salespeople, warehouse people, et cetera, et cetera. It needs to operate distribution centers. These are expensive to either buy and maintain or rent. It needs to move its inventory around the country. It has enormous challenges. And the retailer, in sharp contrast to the Googles and the Microsofts we talked about at the very beginning of our discussion today, those are the guys who don't steadily cash flow evenly throughout the year, right? There's Black Friday. Why do we call it Black Friday? Because those guys are in the red 3/4 of the year or more. Okay, so how are they conducting their businesses? They're borrowing money 3/4 of the year or more. So they are big users of revolving credit facilities. They always have been. Let's talk about what's happening in retail lending specifically. It'll tell us something about that industry and operators within that industry. We can distinguish some of them. And it'll also tell us something about banking. So the first thing to note is there's been an enormous number of bankruptcies in recent months in the retail industry. So everybody knows this. Who are the entities that have filed? You got Bed Bath & Beyond, Christmas tree shops, Rockport with those squishy shoes for old men. You got David's Bridal, Tuesday Morning, Party City. These come to mind readily, half a dozen very significant large companies. Now, I'll ask you, Ash, and your viewers, do you notice anything that these entities have in common?
Yeah, they're all based on brick and mortar.
Well, two things. You've hit one of them right on the button. So all of them are principally brick and mortar companies. And when I say they're principally brick and mortar, it's not a death sentence to be a brick and mortar company. There are experiential retailers that are doing wonderfully in this economy. But if there is not a suitable balance between your brick and mortar presence and the expense and the labor and the cost associated with that on the one hand, and your e-commerce presence, you've got a problem. And the other characteristic that I want to add with respect to all 6 of these entities is these are all non-luxury, non-designer, non-upmarket businesses. So let's take a look. I have a slide, and you may or may not have flashed it already. I've got 2 slides, actually. One reflects the fact that e-commerce business relative to brick and mortar business is obviously ascending. And there it is. And it's precipitous and significant, and it's going to continue. The other slide demonstrates the other piece of this puzzle as it relates to the entities that I listed out that have filed for bankruptcy and the retail market generally. And that slide shows you that more and more, a greater and greater proportion of consumer dollars is going to the LVMH, Moet Hennessy type companies of the world. So Obviously there's inelasticity of demand by the rich, and they will continue to buy expensive goods and services, regardless of the economy we're in. And so what does this mean for retail? It means that if you're in the good group, you do a lot of e-commerce, you have a lot of fine experiential characteristics associated with your retail business. You're on the high end of the market, you're sort of a luxury brand. You're somebody, excuse me, you're somebody who can do very well with lenders. Lenders are willing to lend to you. You're going to generate plenty of working capital, and you're going to continue to borrow on pretty good terms. If you're in the other group, you're going to struggle worse in this current tight credit environment than you were even doing in prior periods. So that's notable.
So let's talk about the breakdown here. Again, the menu of credit options between traditional lending. Obviously, we've talked a little bit about this, revolving lines of credit with traditional financial institutions, banks, and then the non-traditional piece. What are the major buckets on the non-traditional side? I know one of the things that I'm eager to talk to you about, because I don't know a whole heck of a lot about it, but I know as an asset class, it's becoming incredibly more important with the passage of every month, is the private credit markets.
Yes. So the private credit markets, now there's an interesting interrelationship between the ascent of the private credit markets and the ascent of a particular type of private lending that I find myself doing at greater and greater volume. And that is something I'll call lender finance. So I doubt your audience is familiar with this. This is a very esoteric niche of the lending market, but I'll simplify it. Lender finance is basically providing a warehouse credit line to a borrower that is itself a lender. So, okay, let's slow that down. So suppose, for example, a hedge fund raises $1 billion and it says, I'm going to use these $1 billion in a platform that I'm going to establish, which is going to be a lender, which is going to compete with the banks. It's going to lend to businesses. So I'm going to run a lender finance business. So what happens is they are going to want to leverage the money they've raised so that they can increase their IRR. And they open up a warehouse line and thereby leverage the size of their facility. And what happens, and this is kind of nuanced, is that the ultimate lender is sort of derivatively and secondarily secured by the collateral that is taken by its borrower in its own borrowers. And so it's a fairly complex debt stack, but this is a market that is increasing dramatically, lender finance. And the reason that that's happening is twofold. More and more businesses are setting up to lend to lenders, and more lenders who are not banks and who want to leverage their platform are growing like crazy at the moment in time when banks are making fewer loans and have more rigorous criteria attached to their loans.
Well, you just made an interesting point there, which is the rigorousness of the criteria that are attached to the loans. It sounds like what essentially is happening here is it's almost a kind of regulatory arbitrage where you have less regulated entities who have greater flexibility in their ability to lend that don't have the alphabet soup of regulators scrutinizing them. And as a consequence, you see that flow of credit happening in the non-traditional lending markets.
That's exactly the story. And so I have bank clients whose employees call me all the time and say, I'd love to do this deal. 5 years ago, this was right in our sweet spot. It looks great. I can't do it. Why not? The box that we're consigned to by this alphabet soup of regulators is such right now that it doesn't look secured in exactly the proper way. It doesn't look like it's in exactly the sweet spot for us. It runs afoul of the directive that says we can only have so many borrowers in a particular industry, for example. And we already have too many borrowers engaged in this industry, notwithstanding that the industry in question may be the hottest and best place to make loans right now. So my bank clients are constrained, and it's tricky for them. And let me tell you a very practical reality that goes along with this. So if you're a business development officer at a bank, your job is to go out and talk to CFOs and find loans, to tell the guy, hey, I see you have a credit line with XYZ right now. Well, we here at ABC, we can give you a more flexible, more favorable credit facility. Why don't you come over and move your borrowing activity over to us? They're salesmen with accounting and economics backgrounds. That's what they are. Right. Well, guess what? The best guys in that space, they make the best living possible for themselves when their institution is giving them the support and the flexibility to do a larger percentage of the transactions that they come in and present to a credit committee. What am I saying? The guys who are really good, they're moving over to private debt. Why? Because they can get paid. If they can't get the loans closed at the bank, they can't make the living that their expertise really merits for them. So it's very interesting.
Yeah, and obviously these are very bright, sophisticated individuals who are rational actors, are going to go where the cash flow is. Lon, I'm enjoying this conversation immensely because typically I talk to economists who look at these things in various sort of abstract ways, but to actually understand the microeconomic underpinning, why the agents do what the agents do, from someone who's actually in the room with them, I think it's just fascinating. But I wanted to give folks just a little bit of an idea, talking about the macroeconomic side, about what some of the size of this market and its growth, because it is so important, I think, for people to understand the scale of this, what we're talking about here. So the private credit market in 2020 was $875 billion. At the start of 2023, this year, $1.4 trillion. And it's predicted to essentially close to double, $2.3 trillion in the next 4 years by the end of 2027. I did my homework last night to keep myself from getting left in the dust in this conversation. And this data is from from Morgan Stanley. So obviously, folks can see rapidly growing market.
Yeah, listen, we're in an environment where technology change is everything, right? And the only way for businesses to keep pace, to stay at the front, to be agile, and all businesses learned agility during the pandemic experience. The ones that were agile were successful, and the ones that were entrenched and less agile tended to be less successful. I'll tell you something interesting. The financial institutions that I represent, they now include an analysis category for the agility of management and the agility of the infrastructure of the business as part of their underwriting process. That was never considered previously.
So what does that mean, Lon? What exactly does that mean in practice?
Okay, so suppose, for example, you're manufacturing something, okay? If all your manufacturing happens at one plant, you're less agile than a guy who's got plants in 4 jurisdictions, because there could be a quarantine in 2 out of 4, but you've still got 4 running. Suppose, for example, that your manufacturing input is derived from one supplier only. You are less agile than a guy who can obtain that material input from 5 or 6 different suppliers, because your one supplier might be shut down in a regional pandemic, but the guy who's got 4 or 5 suppliers, he's going to continue motoring along. So agility means that you've diversified the infrastructure of your business, number one. And also, you may have an inherent agility in that your assembly lines, if you actually produce something physical, are geared toward shifting to other product lines, again, with agility. You know, it's like a wartime mode. The people who in World War II who were able to stop making, Schick razors and start making, canteens or something that needed to be sold to the armed forces, these guys made a fortune. Some of them were criticized for how well they did during wartime. Right. The same thing. Some of the COVID success stories were criticized for how quickly they were able to make safety gear when they previously made some consumer product for which there was no demand.
Yeah, they were criticized for alleged profiteering, et cetera, et cetera. One of the fascinating things about what you just said, Lon, is it represents a dramatic reversal. I spent, before journalism is my third career. My first career was in IT and business process reengineering. Then I worked in banking, obviously, at large banks for a long time. And now as a journalist. But what's interesting is I remember when I was a young guy in my 20s, this idea of just-in-time inventory, that you had the smallest possible inventory stack that you could possibly have, that you wanted to do the opposite of diversify your supply chain sources. You wanted to lower the cost to the greatest extent possible by, going to only the cheapest supplier. It's so interesting because it's kind of the reverse of the Nassim Taleb view of anti-fragility. We created, almost by financial design, the most highly fragile system, and then we saw what happened during the pandemic, which was it broke. We saw supply chains break. We saw distribution chains break. We saw all kinds of problems in transportation, et cetera, et cetera. So it's so interesting to see that lenders are now favoring businesses that create anti-fragile and therefore agility. I mean, it's just a really interesting sort of shift.
It was very revealing. And, I've got another slide that feeds into what you just observed, Ash. One of the interesting things is that the logistics and shipping companies, as we all know, they experienced remarkable growth during COVID. So they had tremendous success. But when markets normalized, take a look at how dramatic this chart is. When markets normalized, they basically fell off a cliff and returned to their normal. So let me tell your viewers and listeners something interesting about lending that may seem obvious, but investors like to get in when a company has struggled and it's about to improve. It's often overlooked that lenders like to do the same thing. People like to get the best possible deal. So if you're lending to a company that just got through hard times, the company's balance sheet doesn't look that great. The company can't put its best foot forward in going to the bank or other lender. So what does that mean? It's going to pay a lot for its money.
Right.
It's going to be highly constrained in terms of its flexibility. The lender has the upper hand, but the lender is thinking, I'm getting terrific terms, but I'm also aware that this business is just about to turn the corner.
Right.
And so an appreciation of projections is something that informs underwriting and lending strategy by all lenders. And so while lenders were delighted to make loans to people who were in the shipping and logistics business prior to and during COVID, at the moment, they're declining businesses. And so they are not favored by lenders. They're struggling. They're struggling to get borrowing on decent terms.
Yeah, it's fascinating and almost counterintuitive, the idea that when there's more potential risk, if you can project going forward, you basically can get the best of both worlds. You can have a higher credit-worthy entity that you're lending to, while simultaneously being able to charge higher rates and therefore generate greater fees for everyone involved.
And that's the lender equivalent of the stock market customer who wants to buy low and sell high. It's exactly that. You try to minimize your exposure and maximize your return. And the lenders do it. And I don't think people have a real appreciation for how thoughtful they are in doing that. Some are better than others.
It sort of reminds me when I was a young guy and talked to someone who worked in the consumer finance, was in the credit card business, and said, what we call people who pay off their bill at the end of the month, we call them deadbeats, right? Because you don't raise any money on you. It's kind of this counterintuitive aspect.
Correct. That's those guys are the zero IRR component of the business. And so you really don't like those guys very much. I'll tell you another interesting example. And, we talked about upmarket and downmarket retailers before. Here's a corollary, almost opposite example that feeds from the post-COVID experience. So during the COVID era, anybody who was making a consumer good, toothpaste, toilet paper, we know the answer. People weren't just buying the stuff, they were stockpiling it, right? So these guys could borrow on virtually any terms that interested them. I think there's a chart that I have coming up in a moment that talks about the fact that consumers were buying the household brands. They wanted Kleenex and Clorox and and Crest toothpaste. And they were buying this stuff in sufficient quantities that they could store it in the basement like the apocalypse was coming.
Right.
So now, why did that happen? You had scarcity or a perception of scarcity, and you also had the government printing money, handing people money and saying, hey, you might want to stockpile this stuff. We're not sure how much of it is going to be around. So the government was subsidizing it. You had an environment in which people were nervous. Obviously, people were buying the stuff like hotcakes. Okay, then what happens? Now we find ourselves in an inflationary environment. Things are really expensive. Gasoline's a fortune. Things are expensive in the grocery store. So while you have a tremendous demand for LVMH, Moet Hennessy, branded handbags and shoes, in the grocery store, guess what's going on? The exact opposite is happening. Suddenly, the public has a tremendous appetite, no pun intended, for house brands. Well, what does that mean? Lenders, and I've spoken to several clients of mine, they are reluctant to lend to the company that is making its fancy name brand foodstuff product. And they are very eager to lend, for example, to the guy who makes the generic house brand product that you see sold under the ShopRite, Whole Foods, Kirkland generic brand. So
this is a bit counterintuitive because it essentially seems as though you have this bifurcation, the two sides of the market here. On the one side, you have the Louis Vuitton view of the world where we've seen those retailers do very well. And on the other sort of wing, you're talking about folks who are probably financially constrained, who are looking to find the best value for their dollar going out and buying store brands.
That's right. And the difference, of course, is that you may or may not need a handbag. You certainly don't need a $5,000 handbag. Everyone needs nutrition. Groceries are an absolute necessity. So people are saving money on these necessities. As I said earlier, there's a complete inelasticity of demand at the ultra high end of markets. And that's why that's a diametrically opposed dynamic. The second example seems counterintuitive, but it's actually logical. And I'm in the middle of doing a credit facility right now for one of my clients that's lending to a big house brand food manufacturer.
Yeah, maybe slightly depressing about what it says about income distribution in our society, but an important point. Listen, let me just make one other point here because I think it's important. People who are interested in this conversation, who find this intellectually stimulating, but trying to figure out how it applies to them, talking about private credit markets, one of the interesting things that we're seeing right now is a series of retail-oriented funds spinning up. In June, I believe, BlackRock, obviously the largest asset manager in the United States, one of the largest in the world, announced a fund for accredited investors to get exposure to private credit markets. So historically, this has been something that's been these products have been purchased by institutional investors, by allocators, by pension funds, et cetera, all the usual suspects. But now, essentially, you have retail investors who are getting in on this space through these funds via places like BlackRock and Blackstone. Obviously not investment advice, but important for people to understand why this is relevant, particularly as we've seen the breakdown of the 60-40 portfolio in a rising rate environment. So from an investment perspective, if you're a retail investor and you're listening to this, this is why this is relevant in your life.
I think it's right. There is greater interest in having some segment of portfolios reflect lending opportunities, public and private debt. Obviously, people have always looked at banks as part of their portfolios, but there are obviously listed hedge funds in which people can invest, and they in turn, as Ash points out, are establishing new investment vehicles that are dedicated to lending money. And the lending of money is a damn good business. It can be done on a secured basis. It can be done on an unsecured basis. There's different structures, different risk and reward associated with different structures. But the lending of money is a glorious business that's been going on since the beginning of time. People want a piece of that action. And I think Ash is right there when he says that's something people should be focused on. The other takeaway, I think, from all of what we're talking about is that it's important in evaluating equity investments, in evaluating industries, in evaluating particular companies, to have something more sophisticated than a monolithic view of debt and credit availability. It's too facile to say money, as we started out talking, money is expensive and hard to come by. It's important to think with greater granularity, from whom might lending be available to the company I'm interested in? Where is the company I'm evaluating being perceived by prospective lenders? Where in the business cycle are they relative to the availability of liquidity at a price from various sources? So all of that needs to be considered in a much more nuanced and narrow way than by generalizing about the state of the debt or equity or any other market.
Yeah, very well said. I was going to ask this question, but Steve, one of our viewers, has beat me to the punch. And the question is, what are the risks of private credit, Lon?
Okay, it's interesting. So the risks of private credit will vary by the mandate of the particular private credit platform. So I know that sounds very vague, but I'm going to dig in. So if you're investing in an enterprise that has established itself as, for example, a secured asset-based lending platform, well, this is what you'd be getting. You'd be investing in loans that are secured by 100% of the assets of the borrowers. So that's a nice thing. You'd be investing in loans where the advances that are made to the borrowers are merely a percentage of certain specified assets of the borrowers in question. So let's drill down on that. Sorry to bore you with all this detail, Steve. So if you've invested in an asset-based lending portfolio, you put in $1 million. They're lending to companies where they do a loan, they get a lien in all the assets of the company. They're lending against certain assets of the company only, perhaps inventory and accounts receivable. They're not advancing 100% of the value of the inventory or the accounts receivable. Maybe they're advancing 80%. So let's roll back and get a broader vision. The loan in question is dramatically what I would call oversecured. There's vastly more collateral than there ever is an outstanding debt obligation. Why is that important? Because the likelihood that the loan doesn't get repaid is literally infinitesimal. And as somebody who's been in this market for forever, I can tell you that the only situations in which those loans fail tend to be outright fraud. And so these investments are pretty darn secure. Now,
so Lon, talk to us a little bit about the security interest and the priority of the creditors in the event that something goes wrong. How does that structure break down? You talking about securing things by things like accounts receivable. So these are things that are cash assets, and therefore, if you're lending at some factor of those, it's presumably relatively secure. In most cases, obviously not investment advice, but just to try and understand the broader picture of the risk profile.
Yes. So when you decide you're going to lend money to a business, you can do it in any number of ways. If you're lending to General Motors, they can walk in and say, hey, I'd like $1 billion. And the bank shakes its hand and says, okay, here's $1 billion. I'd like it back in 2 years with interest. It takes a lien in absolutely no assets of General Motors. It probably negotiates a series of financial covenants with General Motors so that if its performance were to begin to deteriorate, there would be an early warning system that would let the lender, or in that case, syndicate of lenders, inevitably, getting back to something else we talked about, let them get to the table with General Motors early enough to work the problem through. Now, with a non-General Motors, like we're talking about, taking a lien in all assets is a legal specialty. It's one of my specialties. Those assets could be domestic or international. They're often international. And keep in mind, they include all manner of things that are rarely loaned against. So for example, the lender has a security interest in the trademark, the name of the business. You've probably seen that the Sharper Image store doesn't exist anymore. We all used to go to the mall, sit in the Sharper Image vibrating chair, say, wow, this is really nice. I used to joke to people that they don't really have much of a business model. They should charge people $1 to sit in the vibrating chair. They would make more money because nobody ever really walked out of there with anything.
Yeah, they were like $4 grand in the 90s.
right? It was like unbelievable. Well, the sharper image name is still around because in connection with the liquidation of the business, and by the way, I don't think any lender ever got hurt lending to them. In addition to selling off the fancy radios and the vibrating chairs, they sold the sharper image name to some private equity firm that licensed the sharper image name out to all sorts of makers who are providing little things that you can buy online through Amazon, chargers, earphones, this and that. There's a little secondary value associated with sharper image. People say, oh, it's sharper image, must be pretty good. It's made in China like every other piece of technology. But the sharper image name can generate revenue. So in my example, you've got lots of what the industry calls boot collateral. It's kind of British. It's like it's in the trunk, it's in the boot. It's extra collateral. It's not stuff we're advancing against. It's not the accounts receivable and the inventory, the quick assets, the stuff that cycles through very quickly and pays down the loan very rapidly in a deterioration. It's extra collateral, things like real property or machinery and equipment, stuff that I can liquidate if after 60, 90, 120 days, collecting out the sale of the inventory, getting the accounts receivable repaid, I still come up a little short for my lender client. Well, now I go foreclose on some of that other stuff, sell that at market and make them whole. So investing in completely secured loans is a very good investment if it's managed well by people who know how to underwrite them and know how to manage the credit facilities. And obviously you have to trust the business people you're dealing with, their business acumen, their sophistication, the kind of counsel they engage, the kind of companies they lend to, and the kind of diligence they undertake.
Lon, let me ask you this. The differences and similarities between leveraged loans and private credit, give us a little bit of a sense of those two terms because we hear them obviously with increasing frequency in this environment.
Well, the leveraged loan universe it really accounts for the upper market segment of the money center bank type lending. The LevFin we talk about is, it's a chemical company, it's a petroleum company. A syndicate of banks are lending $2 billion. They go out and they share the risk. That's the LevFin market. They sell it down, and that's a tremendous market. The private debt market is everything, packaged and sold or not, that is undertaken by private lenders up and down the debt stack. And as I said, the private lender, they might be competing with the bank with their own private syndicate to lend $1 billion, or they might be lending $3 million to lubricate the wheels with respect to supply chain activity, factoring the receivables of a moderately sized business so that its cash flow is improved and enhanced. So there's a tremendous array of credit products and activities that are available up and down the debt stack. And that's the interesting thing to look at when looking at the marketplace. People often completely overlook the middle market and the lower middle market, where a tremendous volume of lending takes place.
We get a new question in, this one from Ralph. It's always a sophisticated question from Ralph Humphrey. And the question is, what does Lon think of these NAV loans, net asset value loans, private equity firms are getting?
I'm not going to opine on that, Ralph. I hate to demur. And it is a sophisticated question, but it's not a space in which I live. And, I've told people many times, a bad lawyer is one who'll give you advice on any question you ask him. And a good lawyer is the one who will only advise you about things he knows about. So I'm going to tell you that's not in my sweet spot.
Let me ask you this. One of the things I was doing a little research last night on private credit markets because as we talked about, it's such an incredibly rapidly growing space. One of the things that I thought was interesting is that it seems that many of these loans in the private credit space are held to maturity rather than sold or syndicated. Is that something that you have a sense of? And what are the drivers behind that type of activity?
Well, I think you're absolutely right. They're largely held to maturity. They're largely 3-year loans. I would say the market is such that almost every line I close is for 3 years. There were some points throughout my career where 4 years was more common, but I think 3 years is the right window right about now. So why are they held? They're held because in the underwriting process, projections anticipate that they will perform and pay good value throughout the term. In many cases, the borrowers have entered into the credit facility on the basis of a relationship with particular bankers or a consortium of bankers. They want to have a sense that that relationship is likely to maintain itself and to be preserved in place for a period of years. The CFO wants to work with the same relationship manager and loan officer at the bank or other lending institution. And so really the selling of these loans, the ones I'm talking about for the most part, is not the primary goal. Yes, there are businesses that package and sell them immediately, but for the most part, they're held and managed. And the other thing to keep in mind is some of these lenders, especially the banks, and this applies uniquely to the banks, they may be in a position to generate revenue from cross-selling opportunities that non-bank lenders cannot make available. What do I mean by that? If I'm in a 3-year relationship with a borrower as a bank, I may be able to sell them credit swaps. I may be able to sell them commodity hedges. I may be able to issue a private credit card for them. I may be able to attend to all their cash management. I can earn fees doing a lot of other opening letters of credit. So I can earn a lot of fees in addition to the interest on my loans per se. And so cementing and broadening the relationship represents an economic opportunity.
Interesting. Lon, this has been a spectacularly interesting conversation to me. I've enjoyed this immensely. It's great to just have a view from actually inside the room from someone who's advising these lenders on these activities. We tend to look at things from a macroeconomic perspective. It's so helpful to have someone who can bring the view from inside the room. I know our viewers and our listeners are enjoying this immensely. I can see the comments in the live stream. Terrific conversation. I hope you come back and join us again. Before we go, final thoughts, key takeaways that you'd like to leave our audience with.
Yeah, again, I think I alluded to it earlier, and my lesson for the group, and this is a savvy, sophisticated group, and that's why I'm delighted to be here. My lesson is, don't think of the credit market as a singular thing. Consider the various slices of the debt stack, the various lenders, the various borrowers by industry and entity within industry, and try to evaluate an appropriate connecting of the dots when you consider a company. Say to yourself, from whom might they borrow? Where do they stand from a credit perspective relative to their competitors? The more you know about the credit market, the more you know about the impact of the credit market on their prospective borrowers and businesses across the economy.
Perfect point to end on. So much more we could explore. Only one solution. We're going to have you back again to continue this conversation. Lon Singer, thank you so much for joining us.
Thanks, everyone. It's been a real pleasure. Ash, as they say, I'll see you around campus.
See you around campus, Lon. Have a good weekend, everybody.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.